Robschild, no investment advice. Welcome back to the show where we view financial markets through technicals, macro, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Friday, September 27th, 2024. Today's episode, we start with the PCE data a lot of people are looking forward to. Also, personal income, all coming out cooler than expected. This is from Market Watch. I think the most shocking data that came out today was the personal income. This is, month to month. So the last month to month, personal incomes went up by 0.3%. It was expected to go up by 0.4% for August, and instead the actual went down from the last and 0.2% lower than the market was expecting. The columns here, the L is for the last reading of this, E is what the market was expecting, A is the actual, what actually came out today. And as you can see with the personal spending across the board, PCE came in as expected, but PCE year over year, cooler than expected, core, cooler than expected, month over month, and as expected year over year. Overall, muted. As I said in the show, that it would come out muted because I have a crystal ball. But really, it's this part of the cycle. I mean, just like inflation kept surprising us to the upside, it's not going to be that bad, and it kept surprising us higher and higher. We're on the other side of that coin now, I reckon. A very important key part of this that Gareth Soloway on Verified Investing brought up is that this is all while the S&P 500 is currently at an all-time high. So we have inflation cooling off rapidly, seemingly, and surprising us to the downside while the S&P 500 is all at all-time highs and still at a PE ratio of 30, which historically is saying it's very overvalued. Just think about everybody, especially, the very large and wealthy baby boomer generation with all of their retirement funds, looking at, how much wealth they have. Let's say we have a 10% correction in the S&P 500. Is that going to keep inflation moving higher? It's not going to take much for the disinflation, deflation to escalate very rapidly, in my strong opinion right now, for 1.5 million reasons, this included. S&P all-time highs right now. If it drops by 30%, you think people that have most of their assets invested in the stock market are going to be going out and spending more and more money? I don't think so. So, yeah, there's some, we're headed into a storm, I think, very, very strongly. I see the storm in my crystal ball. Next Friday, the most important data coming out next week is on Friday. We have the unemployment rate come out. I'm not going to read through the daily reminders. I've decided I'm only going to review those on Mondays. If you want to review them yourself, pause the video. Nothing's changed today. And the crystal ball reading remains that a market crash is imminent here, and the Fed will not cut fast enough to save the economy. I said in a previous show I got longer dated HYG puts to sleep better at night, but I just see this bubble. I see a balloon that just keeps filling up with air about to pop, and I can't help myself. I bought more HYG puts today. I'm again, I'm not going 100% portfolio in here. I'll at any given time I'll be maximum 2% in this. It's too cheap to me. The amount of risk priced into markets, there's nobody scared at all right now. Which adds to the daily reminders that now is probably the best time to be the most scared. And HYG puts is one of my favorite ways to get exposure to the bear side of this whenever things blow up or continue to blow up. If you consider the first one to be the yen carry trade, or maybe the bank blow ups right before that, right? On to the charts, the S&P 500 essentially sitting at all-time highs. On a weekly basis, we are at a closing all-time high. This line right here being a parallel from these two bottoms here, we bounced off here, and I don't know if we're going to keep knocking on it and go higher. I think Mr. Market's crazy if he wants to keep going higher right now, but I don't control Mr. Market. From a very basic charting perspective, it would make more sense for us to stay within this channel here. So, bottom, top. A lot of times what happens is you end up going to about the middle to fight it out before deciding if you want to go back down to the downside or to the upside. That's one way of looking at it. Very interestingly, the VIX popped up today. When you have good news that, inflation is cooling off, that wages aren't increasing so greatly, that, again, used to be like good news. It means, it means everything's like honky-dory. And the VIX had a pop today based on PCE and personal income. So a little bit of fear creeping into here. Also, the October VIX futures term contract rose today pretty substantially. It's above almost all the rest of the curve. It's above all the way out through, what is this, the April contract now. So, yeah. The way I look at it, again, smart money is being very cautious here, while dumb money has zero fear. TLT, my favorite place to be, back above this previous trend line. I'm not sure how meaningful this trend line is anymore. I don't have access to price volume charts myself, but I do have a commenter. Thank you for your comment mentioning that 96.64, the level in TLT, has a high volume here. And so this can act as a floor. What it means is that there has been a lot of buying and selling at that range, and so there's a lot of people waiting there, basically. So if you're bullish TLT, it could be a place to buy in. Yeah, and as you know, I have over 50% of my portfolio exposed to long duration treasury bonds. It would work out perfect for me if we, went down to this line over next week, and on Friday when the unemployment report comes out, if we could be right there, that'd be great. Because if the unemployment comes in like, let's say 5%, something ridiculously high, I'll be putting the rest of my cash in probably TMF, actually. It's a triple leveraged version of TLT, essentially. Obligatory reminder, you are watching a guy with a crystal ball. This is not investment advice. HYG, the fund that I keep loading up on puts on, climbed to a new high today, which is partly why I got more puts on it. I was honestly expecting this little flag looking thing to break down. It didn't. It broke up. I'm getting more bearish. As I keep saying, there are so many paths for junk bond yields to be rising here. If the economy is cooling and rates are falling, well, that's great for treasury bonds, but it puts junk bonds at higher risk for default because people are spending less money. So credit spreads widen, value of HYG drops. Let's go to the other side. Let's say the economy is fine, honky-dory. Let's say unemployment's low, everything's fine. Well, then inflation can at least stay where it is or even pick up from here, making rates go higher. And if all rates go higher, HYG goes down. And as rates go higher, it's more expensive to borrow money, putting even more pressure on it to go down. So there's a lot of pressure here for it to go down. I'm starting to wonder if, I saw ads recently for junk bonds, people selling junk bonds actually recently. I'm wondering if there's some shady players out there that are purposefully trying to dump high yield corporate bonds onto the poor retail investor, right now. Again, I can't guarantee that junk bonds are going to drop here. To play devil's advocate, all right, if all yields drop and everything continues to be perfectly fine, then yeah, HYG can actually keep going up in price here. But there are so many things going on. The way I see it is HYG has a lot of weight on its shoulders, and it's not going to take much for it to drop here. Not much at all. It's like a pinprick. It's like a balloon. That's why they call it a bubble, right? Stock market bubble, housing bubble. This stuff is in a bubble, in my strong opinion. One of the things, adding to the weight of the shoulders of the market is oil. Recently rolling over the last 2 days, I said it was accelerating to the downside. I was wondering if we were going to get an even larger red candle today, but we didn't. We got a green one. So no 3 black crows, as they call them. That would be extremely bearish, like imminently. Instead, looks like we went sideways for 1 day. Who knows where it can go from here? But, scrolling out a little bit, oil's been going down and down and down, all while junk bonds are going up. Stocks are going up. People are spending less money. People are making more money at a slower rate, which eventually translates to, less money. But if you've been following the show, I've been semi-bearish and more recently a lot more bearish. And I'll continue being more bearish as time goes on. Until it becomes even just more obvious to everyone where we're really headed. Last chart of the day, KWEB. I probably have 15% of this in my portfolio now. This is just unbelievable. Chinese stocks going to the absolute moon here. I'm going to have to, I drew this arrow pointing up a while ago. I'm going to have to drag it up. My exit point is around the $45 to $50 range, because I think that these equities are more fairly priced around there. I think they've been suppressed and have been way overly cheap for a long time. I imagine part of this motion up is also a little bit of short squeezing. Anybody that was short down here after, if you're still short and it's gone up this much, you've dug yourself in a pretty deep hole. This is the kind of thing that can blow up hedge funds, by the way. It's good to remember that K-Web, this is not supposed to move this quickly. This is an index. This is an index of tech companies in China. This market is astounding. And that's all for today. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching. Stay safe out there. And see you next time. Robschild.